Well, I'm Jagendrana. The topic of the day is ECGCs Operating Performance Assessment. ECGCs Operating Performance Assessment. ECGC has also benefited from favorable prior period claim reserves development driven by better than expected claim experience and its conservative reserving methodology. So, notwithstanding the volatility in preceding years stemming from heightened geopolitical risk and economic uncertainty. In addition, favorable investment income continued to support overall profitability. Because this only state-owned Export Credit Guarantee Corporation of India recorded strong technical earnings in the fiscal year 23 and 24. AM Best, the rating company, has revised the outlook to positive from stable and affirmed ECGC's financial strength rating of B++, that is good, and the long-term issuer credit rating of BBB+, good. Concurrently, AM Best has affirmed the company's India national scale rating of AAA, means in exceptional, with a stable outlook. So the rating reflects ECGC's balance sheet strength, which AM Best assesses as very strong, as well as its adequate operating performance, neutral business profile, and appropriate enterprise risk management. So in addition, the rating factor in a neutral impact from the company's ownership by the Government of India. The revision of the FSR and long-term ICR outlooks to positive from stable reflects an improvement in AM Best's view of ECGC's operating performance assessment, supported by an improving trend in the company's underwriting performance, particularly within its export credit insurance to banks segment. So ECGC's balance sheet strength is underpinned by its risk-adjusted capitalization, which is expected to remain at the strongest level over the medium term, as measured by Best's capital adequacy ratio. The ECGC benefit from good financial flexibility supported by capital contributions from India's government. In addition, the company has a low to moderate risk investment portfolio. An offsetting balance sheet strength factor includes the company's net exposure to severe state scenarios, although the risk is mitigated in part by the company's robust capitalization level. ECGC's business profile is assessed as neutral. The company is monoline credit insurer, providing export credit insurance to bank and Indian exporters. As a market leader in the export credit insurance market in India, ECGC insures approximately 40% of the total export credit disbursement by banks. However, the company's book of business exhibits limited product line diversification and a high concentration of risk exposure to a small group of exporters. So furthermore, its underwriting portfolio is exposed to moderate to high reserving risk, given the long tail nature of credit insurance claims. So AM Best, which rates insurance companies globally, has revised the outlook of ECGC India to positive from stable. The financial strength rating is B++, and the long-term issuer credit rating is BBB plus. So the India national scale rating is AAA. So an exceptional with a stable outlook. The rating performance, neutral business profile and appropriate enterprise risk management. They also factor in a neutral impact from government ownership. The revision in the FSR and long-term ICR outlooks is attributed to improved operating performance, particularly in the export credit insurance segment for banks. The ECGC reported a strong technical earnings in fiscal year 2023 and 2024, supported by favorable claim reserves, development stemming from better than expected claim experience. The company's conservative reserving methodology has helped manage prior volatility, while favorable investment income continues to bolster overall profitability. So ECGC's balance sheet strength is underpinned by strong risk-adjusted capitalization, with best capital adequacy ratio expected to remain robust. The company enjoys good financial flexibility due to capital contributions from the government and maintains a low to moderate risk investment portfolio. However, there is concern over net exposure to severe stress scenarios, which is partly mitigated by the company's strong capitalization. The business profile of ECGC is assessed as neutral. So the company is a monoline credit insurer covering about 40% of total export credit disbursement by banks in India. Despite being a market leader, ECGC has limited product line diversification and a high concentration of risk exposure to a small group of exporters. The underwriting portfolio faces moderate to high reserving risk due to the long tail nature of credit insurance claims. Ratings are communicated to rated entities prior to publication, and unless stated otherwise, no amendments were made after that communication. So a severely detrimental risk faced by exporters in India or Indian economy is the risk of default in payment of foreign buyers. On the other hand, commercial banks have to bear the risk of default by the exporters while lending credit to the latter. The Export Credit Guarantee Corporation covers both these risks and charges a premium in return to foster export in the Indian economy. So ECGC's role in providing export credit insurance to banks is as important as its role in ensuring the exporters against non-payment by foreign buyers. In this context, a comprehensive study sponsored by ECGC Limited was conducted at the Indian Institute of Foreign Trade to assess the role of ECGCs in furnishing short-term export credit insurance to exporters and banks with a view to boosting the performance of Indian exporters while simultaneously expanding its own business. So the study comprised two primary surveys, one of the exporters and another of the banks. According to the primary survey, the most important risk that exporters sought protection from by purchasing ECGC insurance policies were the risk of protracted default by the buyer, followed by the insolvency of the buyer and or insolvency of the letter of credit obtained bank. Among these risks remaining even after obtaining an ECGC policy, the maximum risks were associated with the letters of credit given by importers, risky distinction markets, and exchange rate fluctuations. So other risks highlighted by the respondents were those faced by obtaining simple and single window approvals, and those arising due to a lack of adequate information about the role played by banks in assisting exporters. 75% of the exporters, which comprised all policyholders and half the non-policyholders, were found to be adopting formal risk management policies. Of the exporters that did adopt explicit risk management practices, taking an ECGC policy was the mechanism used by 7 out of 10 of them. So for financial related risk, the exporters dependent either on banks or practiced self-management. The policyholder exporters reportedly performed relatively better than their non-policyholders counterpart in terms of both average domestic and export sales. Moreover, they have been able to employ about 3 times the number of people employed by non-policyholders, as higher sales expectedly necessitated more manpower. Most of ECGC's export credit support is focused on sectors like textiles, ready-made garments, engineering goods, chemicals and pharmaceuticals, and leather products. The ECGC can easily expand and diversify its insurance support to other sectors such as marine products, plastic goods, granite, tea, etc. by framing announced policies to address the common and special risk faced by the exporters in these sectors. To further enhance ECGC's policy adoption among exporters, removing procedural obstacles to ensure faster approval and a smoother claim settlement emerged as the top suggestions in the responses of the primary survey. Other important suggestions included introducing flexible maximum premium rates and discounts, expanding credit limits, and removing restrictions on the coverage of risky destination markets. So banks provide export credit services and other financial solutions to enterprises of all sizes and scales, most of which are micro, small and medium enterprises, that is MSMEs, to assist them in improving their export performance. So most of these banks furnish short-term working capital export credit services, while some of them also provide medium and long-term export credit services. The key sectors to which banks are providing export credit services are textiles and ready-made garments, engineering goods, chemicals and pharmaceuticals, and gems and jewelry. So banks would not readily assist exporters if they were not supported by ECGCs in turn. The ECGC's export credit insurance to banks encourages them to extend credit to exporters by offering capital provisioning and indemnification to banks through its insurance cover and payment of claims respectively. So the primary survey of banks identified the most important factor motivating them to take ECGC cover as the protected default of exporters due to their insolvency. So by buying ECGC cover, banks secure indirect risk protection and prevention of capital loss in case of default by exporters. On the other hand, the chief reason for the low adoption of ECGC's policies among banks were found to be a lack of funds, procedural obstacles, and the unavailability of features in the insurance cover specifically desired by the banks. So these challenges can be overcome by ECGC with minimal adjustment to its insurance policies. ECGC could also nudge banks to enhance insurance policies adoption by providing greater relief to them in capital provisioning through insurance covers and indemnification through claims. Other important suggestions for ECGC Limited to improve the reach and use of its policies to increase its ECIB business are similar to those for enhancing policy adoption among exporters. These include faster approval, a smooth process of claim settlement, reducing the premium amount, increasing the risk cover, raising awareness of its policies by providing relevant information through online and offline channels, and introducing customized policies for the banks. In order to run its own business by extending insurance support to exporters and banks, ECGC provides insurance cover to around 20% of the merchandise exports from the country destined for more than 200 countries of the world. In recent years, ECGC has introduced several new product measures to bolster support for Indian exporters. For example, it has introduced new insurance products like the export factoring facility, export factoring facility, which provides a package of benefit comprising finance against receivables, fulfillment of working capital needs, and maintenance of a sales ledger for transactions with a specific buyer to meet the growing demand of Indian MSMEs exporters. So ECGC has an impressive track record of adopting innovative insurance policies to aid and assist Indian exporters in enhancing their export performance. Hence, incorporating the above-mentioned improvements in its policy formulation is an eminently doable task for ECGC. Once that is done, ECGC will be comfortably placed in the various cycles of expanding its own business and boosting Indian exports. So ECGC has conducted a comprehensive review of the countries covered by them based on the revised risk methodology that has been put in place. So this revised methodology aims at evaluating the country not only on the prevalent economic and political settings but also on the corrective development that would have an impact on the future, with an increase in the horizon of 12 months as well as forecast based on its strength and weakness of the country in terms of its economic and political strength. ECGC classifies the countries into 7 categories in the ascending order of risk perceived by, with insignificant risk, low risk, moderately low risk, moderate risk, moderately high risk, very high risk. The revised country classification based on the revised model is effective from 1st December 2006. As per this revised classification, 6 of the 12 countries of the CIS region have been upgraded. Russian Federation is now placed in Group A2. Classification of CIS countries is given in paragraph. Kazakhstan and Russia are upgraded from Group 1 B1 to Group A2, while 4 countries, namely Kyrgyzstan, Moldova, Tajikistan, Turkmenistan, moved up to C plus from high and very high risk group of C2 and D. So the remaining 6 countries are placed in the moderate risk category of B1 and B2 in the new classrooms. No CIS country is placed in the high risk groups of C2 and D. So Azerbaijan, Belarus, Georgia, Maldives, Kazakhstan, Russia, Federation, Ukraine are placed in the open cover category, which will enable purchasers to obtain cover on a more liberalized basis. For these countries, ECGC cover under short term is available for political risk for all transactions irrespective of limit on individual buyer to bank or bank. However, comprehensive cover, commercial plus political risk is available depending on ECGC's assessment of the credit worthiness of the buyer or bank. So the remaining 5 countries, that is Armenia, Kyrgyzstan, Tajikistan, Turkmenistan and Uzbekistan, are placed in restricted cover category 1, where ECGC cover is available on a revolving limit basis, normally valid for a year on following basis. A revocable letter of credit opened by confirmed banks listed in the bankers' almanac or by local banks whose reports are satisfactory, cover will be 90%. Normal cover of 90% on DPDA terms subject to satisfactory report on the buyers. None of the CIS countries are placed in restricted cover. Category 2, where specific approval is given on case-to-case basis. So the current ECGC classification for 12 CIS countries depends on the listing, that is Azerbaijan B1, Belarus B1, Georgia B2, Kazakhstan A2, Moldova C1, Russia A2, Ukraine B2, Armenia B2, Kyrgyzstan C1, Tajikistan C1, Turkmenistan C1 and Uzbekistan B2. So this is the way how they are classifying their risk. And say the Export Credit Guarantee Corporation of India Limited usually helps the exporters across the country by providing insurance credit which will minimize the risk which are associated with the payments that are due from the country. So this offers protection against the non-payment of any important and gives a good set of security to the company. So the ECGC is wholly owned by the Government of India and also promotes exports across the country, which will provide good credit risk insurance towards the exporters and the services related to the exporters. So concluding that the company gradually look forward to the benefit of the exporters, which will benefit the country's economy. Thank you very much.